And I tell my students that, we go back maybe 6 or 11 years of financial statements and calculate 10 different growth rates. And then from that, maybe get an average, maybe a weighted average of those growth rates. Mm-hmm. And then that becomes our base. And then I tell people that, okay, from here, we can adjust that base to reflect other information that we might have, information about the industry, the overall economy, the people in the firm. And that could adjust our historic average growth to be a little higher or a little lower. And if we don't know any better, we can just use the historic average. So we have that growth. It could be constant or non-constant. When we have non-constant, more realistic, but more and more stuff to estimate and assume. Right. So we have these series of cash flows. And then we find what we call the present value of those cash flows. So we'll take an interest rate that we'll call a required rate of return. This could be the firm's weighted average cost of capital, weighted average cost of raising funds, debt, short-term, long-term, preferred, and common stock. So a weighted average of those.
Weighted average cost of capital is practical. It's cost of raising money after subtracting your taxables. It's common way to figure required rate of return, which is minimum amount the shareholder will want to earn in exchange for giving money to company. They want profit, so we multiply the cost of capital sources and office by the market values, then add together to find the total. So the numbers tell you whether it's safer and share noble.
And we might use that as the rate that we use to find the present value of those cash flows.